We are back. The recent ups and downs of the market are not for the weak of heart, with the crisis in Asia sparking turmoil in just about every market. Our next guest spreading himself out without spreading himself thin. His strategy seems to be working. He runs the Hotchkiss & Wiley Balanced Income Fund, a fund up more than 86% in 5 years. The fund has 62% of its assets in bonds, but it is still buying equities as well. Here to tell us what's going on is Roger Debard. He's portfolio manager of the Hotchkiss & Wiley Balanced Income Fund. Good morning. Thank you very much for joining us.
Good morning, Michael.
More than half in bonds right now.
More than half, primarily because of the increase in prices in stocks, the lower valuations today compared to bonds. We may look out in the next 12 months and be very happy with a 7.5% return on the bond portfolio.
Well, obviously, if 7.5%, you're buying corporate bonds, right?
Mostly mortgage securities.
Mortgage securities.
U.S. government securities, agencies, and some corporate bonds, primarily short-term oriented corporate bonds.
What's your charter like? I mean, can you put your money anywhere? I'm trying to get at the process by which this money got in these places.
Yes. The fund was created 12 years ago with an idea of having a conservative core type portfolio, and the policy range is a minimum of 25% in equities and a maximum of 60. And the idea of that 60 is that it leaves plenty of room for an individual investor, a trustee, to have the latitude of putting a satellite, a small cap fund, international fund, real estate fund, other specialty funds around that basic core.
Kathleen Hayes and I were I think we agreed on where rates were going, heading down or close to that. Where do you see rates going, and where do you see the real value in the fixed income market with as flat of a yield curve as we have today?
Yeah, I think before we saw the Asian problem evolve in the last 4 months, interest rates very likely could have been heading up. You look at all of the economic factors, and particularly in our domestic market, including even currently the trends in employment. I think the Federal Reserve is likely being held hostage on the problems of Asia, Russia, and to some extent what's going on with the economic union in Europe.
Is this though kind of like a hand on a spring, and the moment the pressure comes off, the rates will spring up? In other words, I'm worried about the transitory nature of these forces that are holding our rates down.
I'm more concerned that it isn't transitory, that I think the problems in Asia are structural and are going to just take time to work out. I think it's only been in the recent months that there's been an acknowledgement and now beginning the process of rebuilding, but there is in fact overcapacity. So looking out on the horizon on interest rates, I think interest rates will probably be relatively well behaved.
All right. You think this will persist for a reasonable amount of time? On the equity side, what looks good to you?
Well, we have about 18% in financial stocks, and particularly what
Great place to be yesterday.
Well, it's actually been a good place to be all year.
Yes.
And particularly in the banking sector, the non-money center, the regional banks, I believe this process of consolidation will continue. And so I think that will continue to be a good place to be. They're fundamental businesses. You look around the country, whether it be the West Coast, the Midwest, or the East Coast today, the business climate is very favorable for banking. They're increasing their fee revenues, and they're running their businesses much leaner. So they're good businesses, well-managed businesses.
Let me just ask you, did you arrive at this by saying, by top down, looking at the economy, I want to be in banking, or did you bottom up and you just wound up with a lot of banks?
We at Hotchkiss & Wiley would be characterized as a value investor, so we're really looking for individual companies in individual industries that have attractive valuation characteristics.
Roger, I know one of the other industries that you've overweighted has been utilities.
Yes.
And historically, the year after there's been a capital gains tax cut like we've had this year, it's been a tough year for any dividend-producing stock, of which utilities are one of them, as the wider that rate gets. When it was 39.6 and a 28% capital gains tax rate, investors really didn't care if they're paying ordinary income or capital gains tax. But now, looking at next year, all of a sudden when it's going to be 39.6 or 20, and that gap really widens, investors really take notice. Are you concerned that you're going to start seeing a rotation out of those dividend-producing stocks?
No, we've actually seen a rotation, particularly in recent months, into the utility sector. But it's not so much because they pay dividends or a relatively large, close to a 6% dividend. It's because the prices are such that they represent pretty good value. And the combination of that 6% dividend and maybe a conservative 3% to 4% growth factor will generate a total return of maybe 9 to 10% on a sector that has high degree of probability of getting that return. You can't say that about many sectors of the stock market today.
Roger, thank you very much for dropping by and sharing your thoughts.
Thank you, Mark.
Appreciate it. Roger Debard, our guest, he's portfolio manager of the Hotchkiss & Wiley Balanced Income Fund. All right, still...